I think we are a decent number and we are good to start the session. Hi, Jigar. How are you?
Very well, Aakanksha. How are things with you?
Great, great here on an afternoon, on a hot afternoon in Delhi.
I hear
So,
yesterday was the hottest day recorded,
oh,
so
yes, correct. Of course. I think it is going hotter by the day. So it's just a matter of time, probably. So, with that, I'll quickly start the session. Good afternoon, everyone. I am Aakanksha Shukla, your host and moderator for today's session. I hope I'm audible to all. I would like to extend a very warm welcome on a very warm afternoon in Delhi to all of you joining us for this special edition of Street Experts webinar series by Mastertrust. This is no news. India has been grabbing the global spotlight, from robust GDP numbers to becoming a favorite among foreign investors. But amidst all this optimism, there's one important question we all need to ask. Is this market rally truly backed by earnings, or are we just running on sentiments? That brings us to today's topic, India's global glow up. But can earnings justify the hype? To help us unpack this very relevant question, we are joined by someone who needs no introduction in the world of market strategies. Mr. Jigar Mistry, who's a co-founder of Buoyant Capital, with a cumulative 25 years of experience in equity research and portfolio advisory, Mr. Mistry has worked closely with institutional investors, offering deep data-backed insights on macro trends, corporate earnings, and sectoral performance. He's widely known for his ability to simplify complex market narratives and for presenting sharp, research-driven perspectives that help investors make sense of the noise. Media platforms frequently seek his views, and his thought leadership has influenced decisions across the financial ecosystems. I personally love listening to him on the media. A warm welcome to you, Jigar.
thank you, Aakanksha. Good afternoon to everybody, and very kind words those. So thank you for those as well.
So, without any further delay, let's dive into what's real, what's noise, and where the markets may be headed next. And yes, we'll be taking all your questions, so feel free to drop it down into the comment section. We'll take it towards the end of the session. So, these 6 months have been quite an eventful time. There is a lot to unpack. Globally, the macroeconomic picture remains cloudy. We are witnessing mounting US debt levels, a wave of credit downgrades, and persistent inflation concerns. However, India stands at an advantageous position backed by young demographic dividend to resilient domestic demand, which continues to position India as a beneficiary of shifting global landscape. So, with that, I would like to ask Jigar that India has been doing better than many global markets. What do you think is driving this strong performance?
Right, Aakanksha. So number of things, right? The first part very clearly is sort of how we are. The way we like to put it, a macro darling in an otherwise turbulent world. If you start, and maybe stop me if I'm getting too much into detail, but you look at sort of where the US exceptionalism started, where it has brought us today, the current scheme of things, and then where India is fitting in. So that is the broad sort of route I'm thinking we'll take with this. The first part of this is sort of how US became the centerfold of all attention, and the sort of turn down on that is what's resulting in the turn up for India as an economy. Post sort of Second World War, US emerged as as a very strong economy. Asia, which was predominantly Japan at that time, and the Western economies were embroiled in this elongated war. And US came out very strong with a very strong military might and holding almost two-thirds of the two-thirds of the gold available to the world at that point in time. And that led it to form a very critical part in the Bretton Woods agreement that got the pegging the dollar to the gold prices, and everything else was pegged to the US dollar. That sort of thing ended in 1991 when Richard Nixon pulled US out of the gold standard. And since then, even I would say from 71 to 91, there was a counterbalancing effect because USSR at that point in time was still a very strong sort of military spender, not as large an economy, but a very large military spender. After that, nevertheless, once sort of USSR disintegrated in August 1991, it resulted into sort of a unipolar world, so to speak, We are talking about almost 35 years of dollar as a sole reserve currency. Now, when you are a reserve currency, it affords you a lot of things. I'll give you one statistic. It cost the US something like 8 cents, right? 8 cents to print $100 bill. Countries like India and China have to export, as much as $100 worth of material to get that same $100. And because, US was able to do this, because it emerged very strong from the war, it's technically called seigniorage, and they were afforded that seigniorage. At a certain point, it's now becoming a dilemma because US has expanded the balance sheet from under $1 trillion in 2008, so just because before the global financial crisis, to almost 9 trillion at its peak, and now I think it's crossed the 2022 high as well. And you print so much of a currency, you have to keep supplying that dollars, and it's the more of the supply you create of a commodity, the lower the price goes. So that's one end of the argument, that US is supplying so much dollars. On the other hand of the argument is the fact that a currency to be called a global reserve currency requires sort of certain aspects, right? You need to be a very large economy. You need your currency to be both the store of value and medium of exchange. You want the yield curve to be reasonably well protected. You need capital convertibility, and you need a large militarized industrial complex. If you look at across the world, Euro is a bank without a state. Japan has yield curve controls. China has not full capital convertibility, and not everybody trusts it. India has very limited capital convertibility, and BRICS has no currency. So on the one hand, US is supplying it. On the other, there is nothing else available for countries to park their incremental savings in. And therefore, US sort of kept running those large trade deficits so that it can supply those dollars. And running trade deficits mean that you have to essentially, run sort of production offshore, import import more than you export. And therefore, this is the dilemma at hand. On one hand, nobody else offers what you do. And the other hand, you supply so much that the value is coming to a very large crash. So when Trump assumed office, and now I'm coming straight to the current time, when Trump assumed office, one of the key persons in that administration was a person called Stephen Miran. And he argued, and when he was in the private sector as late in November 24, he put out a 41-page memo where he argued essentially that you are running a core problem of very overvalued US dollar, and therefore you need to do something about it, right? This dilemma is at hand, which is technically called the Triffin dilemma. And so Triffin was the first person who sort of brought this out. And you have to do something about it, which means you have to now, reshore, not just friend shore, not near shore, not friend shore, reshore all productions to the US. Start exporting more than you import, which is how he says, remove all the trade deficits. And that creates a very big problem if they were to execute it. The problem US has, nevertheless, is that Trump doesn't have a lot of time. Right, his re-election, obviously the end of the presidency, so he's a second term president, so he won't get re-elected. His presidency ends in January 29. But as we have seen with previous, second term presidencies, the last year is always a lame duck government. And therefore you're talking 3 years. But US has midterm polls, which will be in November 26, where all 435 seats of the House and 33 seats of the Senate will come up for re-elections. And if you don't produce tangible results by then, you will essentially have to face the public. You can be the president for 4 years, but if you lose control of House and the Senate, then you won't be able to do any good. So on one hand, Trump has very limited time. On the other hand, Xi Jinping has all the time in the world. In March 2018, he removed the 2-term limit for any president. So he's now a president for life. He is the longest serving head of state, head of the party, and head of the military wing. Right? China hasn't had a person serving on all the 3 positions for more than 10 years. Not even Mao Zedong had, the luxury of doing that. And, you have stuffed your Politburo with all your loyalists. So if I'm Xi Jinping, I can think 20 years. If I'm Trump, I have to think 2 years. And essentially, you will then argue that a trade deal sooner or later will now be into place. And therefore, you're not thinking about, uprooting 35 years of dollar as a reserve currency, 23 years of China-led disinflation, and where that will land you if you were to yank it off. And therefore, we broadly construe that we are now part of the recognizable cycle. Essentially, China and US deal will more or less get addressed and will be back to the ways and means that we know. When we come to the market and flows, I'll explain why this has a very key important reason on why you are seeing FIs flow increase into India, but that is a flow question. What does it relate to India? India has sort of a very unique blend of the right place and the right time suiting it today. If I break it down, if I jargonize it, I can tell you that we need more labor force participation, more productivity gains. But at the end, what it means is that you need more people working and people working more smartly. Right? That is the core of the fundamental fabric of any economy. In India, both those things are in place. We have 78 crore working age population today, going to 100 crore plus in the next 2 decades. And the productivity growth with AI, with tech is coming through. So net, India is in a beautiful place where they will be, and this word is oftentimes used, sometimes misused, the dividend that a demography will afford you. And that is channeled in the right direction, and that is equally important that it has to be channeled in the right direction, can yield great gains for next 20, 30 years for India as a country. Now, with that backdrop, when the flows are put into place, you will get into a completely different trajectory, but we'll come to it when we answer the flow question. So from a macroeconomic standpoint, this is what we are thinking. We are thinking that US is sort of achieved a place from which juncture sort of it will be slowly eroding. India is taking on a place where it may not grow as fast as China has, but incrementally the direction is right. So I think this is sort of broadly how, from a macroeconomic standpoint, we are viewing India.
So, Jigar, you mentioned that you're expecting a momentum of 2 to 3 decades from here. What do you think will be the key risks to watch out for during this duration?
Uh, Two or three risks, Aakanksha. First is, from any standpoint, when you get so many people who have never worked are coming into the working age within the country and joining the labor force, you need to put them into a very productive asset class, right? Think of how any country actually ends up growing. You have, let's say, you should talk about the Asian tigers of the late 90s or China early 2000s. The template is aforementioned. The template typically is that all of the labor costs are much lower, and that allows you to manufacture at a very competitive rate. In turn, that allows you to export more than you import. You become the manufacturing hub of the world. That gives you control over your current account. And when you generate current account surplus, you invest all of that into your strategic vulnerabilities, right? So that is the template. Look at China, what China has done. Look at what Asian tigers did. India had a very troubled relationship with this template in the past. In the first instance, it was never, we didn't have labor costs which were as cheap. We always had Narega, Manrega, so we didn't have the labor force which was very uniquely positioned. Secondly, that precluded us from truly becoming the manufacturing hub of the world. And therefore, our current account has, given crude, has always been negative. Whenever we had those positives, India's strategic vulnerability has always been crude, and we couldn't really invest in crude globally to get the advantage out of it. So very clearly, India has sort of, over the past 40 years or so, has sort of gave away the benefit it used to have of a very cheap labor cost. Now we have to, as we keep mentioning, salami slice our way into manufacturing. Thankfully, with COVID, a lot of global supply chain managers realize that we can't have just China as a country to rely on. We need more counterparties, and therefore that comes to India's advantage. India, on its part, over the past 10 or 15 years, has been finding this approach that look, we will incentivize you, get production here. You look at any economy, South Korea, when it grew, you had what's known as chabols, right? So all the big South Korean families, the Hyundais of the world and Samsungs of the world, they started off with government support and then they sort of mushroomed into such large corporations. India, obviously, given its democratic constraints, is not allowed to do a lot of this. But essentially, it's now saying that look, we are introducing PLI schemes. You come and start. You talk about a phone, for example. It costs 50,000 rupees on average. You will say, okay, I'll incentivize you. At least capture 500 rupee of assembly value first. So you have 2 or 3 EMS. Entire space opens up for investing. And then it will say, okay, try and make the glass here. I'll give $20 billion sort of, concession to NVIDIA, set up a chip manufacturing plant. And you have to slowly and steadily salami slice your way into the manufacturing game, which is proving sort of, given the federal structure, some approvals are state driven, some approvals are central driven, and therefore it is creating not so easy path for India. So that sort of bureaucratic federal state red tape, I think, is the first risk. The second risk is that when so many young people come into the labor force, and if you don't sort of put them in a way where you get them employed efficiently, you can possibly risk a lot of social unrest, which no country would want, right? You have this demographic dividend, you don't want it to become demographic liability at the end of it. So very clearly, that is the second risk. The third risk, I would say, is one of sort of overzealous, market participation. I never thought this would actually become a risk, but I'll give you a few statistics, and that will make you realize sort of the kind of problem we are confronting. If I take each and every listed entity, so I'll first give you the lay of the land. So India's market cap is around 5.2 trillion US dollars, of which FIIs own about 18%, mutual funds own 10%, and retail owns 15%, broadly speaking, right? Decimal point differences. So overall, retail in its own hand, I'm excluding mutual fund, life insurance, and ULIP, owns lesser than FIIs. But if you look at the small and micro cap space, so company number 251, all the way down on the market cap list, retail's ownership is 3 times that much as FIIs. So FII ownership is predominantly in the large and mid cap. In the small and micro cap, it is entirely retail. Now, the next set of data I will give you will put things in perspective. If you took each and every listed entity, multiplied it with the retail ownership, as of the bottom of markets in COVID, March 2020, the total of that value was about 16 lakh crore, 16 trillion INR. By September 2024, that number had ballooned to a whopping 67 lakh crores. So as a cohort, retail investors generated a wealth in excess of 50 lakh crores. It might sound like a big number, but how truly large it is, you will realize when you juxtapose this against, say, something like the entire savings of the nation. So if you took whatever India as a country saves in real estate, gold, silver, equity, debt, and bank deposits, all asset classes combined, at the net level last year was something like 14 lakh crores, 1/4. So there are, you would say, what, 30-40 crore in Indians who will be saving. They save 14 lakh crore. There were 2 crore active Demat account holders, which generated a whopping 50 lakh crores in wealth, predominantly from the small and micro cap businesses. And all of them started thinking that there is a new casino in town. Right? The number of mutual fund investors have gone up from 2.6 crores in COVID to 6 crores now. Active Demat have gone up from 1.5 crore to 8 crore now. So many of them didn't really see a 10 to 15% drop until recently. And they started putting money in the same small cap mutual funds, same small cap illiquid stock. The number of folios in small cap funds have gone up 5 times in under 5 years. And the market cap of small caps today is the same, the AUM of a small cap fund is the same as large cap fund, whereas the market cap of large cap is 3 times that of small and micro cap combined. So much money started coming into small and mid cap funds, and that has started creating a dislocation where you're valuing sort of the businesses because there is no free float. The same money is coming into the same stock. and it is sort of completely dislocating the valuations of many of these narrative stocks. The caution point here is that when the market peaked in 2008, almost 40% of BSE 500 companies then. So BSE 500 in 2008 is the best, I would say, 500 companies then. 40% of those companies today are either bankrupt or near zero value. When you value the businesses so dramatically, where you are just sort of because it's done well, you keep pumping money in the same stock, that sadly could create a risk profile, the illiquidity risk, which a lot of new investors are probably not realizing today, and at a certain point they would find out rather painfully that these businesses were not really worth so much. So net net, I would say the three risks as we see are this: a valuation driven paradigm, people not being put to work very well, and sort of the structure of the economy that is growing in wayward directions.
In fact, Jigar, while you were mentioning about the risk, you had also covered that in what department had particularly investors been very active, retail investors. But still, I would like to know that this market rally, apart from the economic factors that are in favor of India, this market rally particularly that we have seen post March, post April, the recovery that we have seen, is it driven by real fundamentals or are investor being overly optimistic?
I would say it's a combination of two things. The earnings have improved. So if you look at, so we'll look at these two parts, right? The earnings and then the flows aspect of it. The earnings have actually improved a little bit, because if you looked at the slowdown that started in April, May, June 2025, that was April, May, June 2024, the last year when there were elections.
Yeah.
That was the time when sort of a large part of the economy came to a standstill. Elections in India cost a lot, and obviously, the country was, saving to pay for that. And net net, it resulted in the slowdown that started. That subsequently, the June quarter was bad, September quarter was worse, December quarter was worse than the previous two. March has seen some amount of uptick within that. However, there are two things that are coming through. One, whereas the earnings have improved, there have been more sort of beats than misses. So beats and misses compared to consensus earnings, especially in the large and mid cap. In the small cap, there are still more misses than the beats overall at the index level. But the construct of the earnings growth is very, very different. The construct is such that you are essentially seeing, and in fact, why don't I actually pull up a slide deck here and run you through sort of how we are seeing the earnings play through. My screen is visible?
Yes.
Right, so just give me a minute right here. So let's say I was talking about two parts. One, sort of the F425, the bulk of the earnings was cyclical driven. So you are seeing sort of contribution to PAT on the left hand side, the index weight on the right hand side. So wherever the indices weight have been higher, you are seeing the contribution not being all that great. And wherever the index weight has been lower, the contribution is higher. Now, this has two parts. One, sort of overall from numeric standpoint, the green is the beat, the gray is the miss. So you see Nifty, more beats than misses. Next 50, same. Mid cap, sort of similar. But when you look at sort of small caps, the number of beats are lesser, the neutral and misses are higher. So clearly it's coming from the large cap space, predominantly cyclical, and that is resulting in a very unique phenomenon. Now, this is a very interesting chart that we track. This tells you that, let's say, if we take 2022 earnings to start with, you are looking at, at the 2022 estimate around Jan 2020 was 735 rupees on Nifty EPS. It obviously dipped with COVID, but then it recovered, and then we ended the year at 730. Next year, 730 ended at 820, 850 ended at 890. So this is 2024 earnings. 2025 was again positive, but when you look at 26 and 27 estimate, because a large part of cyclicals are driving the earnings, the consensus is forced to essentially start dropping earnings estimate. So since COVID, this is the first time we are looking at analyst consensus being far higher on the market earnings profile than what is likely to be delivered, and therefore it's not all that great news. If people want to know sort of where the earnings growth has been come through, we track it on sector by sector basis. Reasonably good sort of earnings growth across the board. But I think the bigger point to look at is essentially that earnings have now started getting cut, and therefore it's not all that great, although earnings have improved a little bit. The other way sort of we will look at this is, sorry, is my screen frozen? Okay, sorry. The other way one should look at it is very clearly on the flows standpoint, right? So earnings are broadly okay. From the flow standpoint, a very important number we need to keep tracking, or rather two important numbers, and again I'll open the screen deck, are essentially forming in the form of how the dollar movement is happening and the Indian rupee savings, right? So let's look at this chart, for example, first. You look at the dollar index, the DXY, which is the dollar against a broader basket of currencies. That has fallen from 110 to below sort of 100 now, 98.8 when we drew this. This has huge implications because if you remember, until 15 years ago, the emerging market and the developed market debate was fairly strong. People believed that every 10 years, money flows into emerging markets and developed markets consecutively. And in the past 15 years, the developed markets, especially US and tech driven, has been great. Now, if I am the asset allocator, if 100 falls, 110 falls to below 100, then by investing in the US, my fund is losing 10% for no reason. And therefore, given that it's already 15 years when developed markets have been doing well, money will start incrementally flowing into emerging markets. And if it flows into emerging markets, India becomes a decent choice because if you look across the board, there are not enough countries which have the positives of India, right? You don't have an economy which is 3.5 trillion or 4 trillion now going to 5 trillion. You don't have a very strong judiciary, a largely nicely operating democracy, a very large consumption market, right? If you look at Brazil, it is all commodities. Saudi is all oil. China is great, but investors have never made money there. So if this trend continues where dollar sort of keeps going down, then sort of you have a lot of incremental allocation in the US come into emerging markets and by sort of implication, India. So clearly FIs, as you have seen, this started happening, picked up pace from February and then March. So since March, we have seen FI inflows remain reasonably high. If people are tracking, this is freely trackable. This is one number that we are looking at. The second number is in terms of sort of where India's incremental savings happen, right? So if I look at 2014 first, the percentage of household saving coming to mutual funds was something like 0.7%. In the last year, FY24, that number increased to 4%. Now, in 1992, at the peak of Harshad Mehta markets, this number was close to 15%. So, if you argue that 4 will go incrementally towards 15 because, at the margin, real estate is not looking all that great, gold has had a great run, but not incrementally. And if you assume this goes up to sort of 10%, then the 3 lakh crore mutual fund flow can actually come closer to 10 lakh crores.
10 lakh crores.
Right. So essentially, you are looking at foreign money coming in, domestic money behaving reasonably well. And therefore, I think earnings have not really troughed up completely. But I would think that flows will keep the markets reasonably well interested.
So, given that we are on the question of earnings, what sectors, as per you, are seeing the most earning pressure right now, and what could drive the earnings in the upcoming 2 years, 3 years down the line?
So the one that is seeing pressure, Aakanksha, as we saw in the last time, was oil and gas, cement, tech, FMCG. Is not all that great. The ones doing very well is metals, pharma, industrials, power, NBFCs, agriculture. So I did show that table where we are tracking, across consumption, exports. So exports is generally very good. Industrials and capex is reasonably okay. Consumption has to be discretionary. Consumption staples are not doing all that well. IT, we don't think will do all that well. Yeah, so I think these are the broad sectors. Banking, with the margin cut, I think a lot of people are worried, but I think banking should broadly be okay because the stance has been changed to neutral now. So you're not looking at, interest rates being cut in a hurry anymore. And we are anyway now at a very close proximity to where the US Treasury, US 10-year is, and therefore I think net bank should be okay within the ones that have not done so well in the run up so far. But I think, yeah, so this in consumption, stick with discretionary. Cement we would think is discretionary, so it's good. Cyclicals we are interested, so metals, pharma, even specialty chemicals, uh, travel, aviation, all that looks great. Uh, IT, oil and gas, consumption staples, we are not that comfortable.
All right. Jigar, with that, I would like to, move on to the global aspects and global point of views. With ongoing global tensions like, this still ongoing Russia-Ukraine war and other wars, plus the rising tariff barriers, how do you see these factors impacting global and domestic growth?
So the tariff tantrum, Aakanksha, we did discuss at the start of this.
Correct.
Russia Ukraine, is not incrementally as meaningful because I think when it first broke out, things were a little off because a large part of potash, which is required for your urea, was important. Government increased the fertilizer subsidy by 2 lakh crores, so they essentially took the entire brunt of it. Otherwise, you would have a very chaotic situation. Crude prices, because of the ongoing conflict, then subsided. So the two things that matter to India out of Russia, Ukraine is crude and urea, or rather potash. And that is what I think has been into the price, so to speak, today. Tariff tantrum, as I said, we think India is. So I will pull up a couple of slides on the tariff tantrums as well. We did discuss on who really wins this, but in the process, sort of by the time that decision is not through, you essentially are looking at two things. One, you're looking at the entire tariff in the US go up from 2% to something like 13 to 15%, depending on how the USMA compliance happens, which how well they sort of get into other countries. But even in the process, by the time this happens, we have included the entire tariff, sort of including reciprocal to 232 to fentanyl. India is likely on average at 11% tariffs versus its other contemporaries, China, Japan, Korea, Germany. All of them are higher than that. The ones which are lower than this, Brazil and Mexico, at least Mexico is part of NAFTA and so is Canada. So they are anyway not really better off than what they were. They're lower than India. And Taiwan exports stuff that we don't. So net, if you look at competition, the costs have gone up for all, but India is still a lot better placed compared to its competitors. What it would mean is essentially on the rates front, right? So we went out predicting that the average US policy rate, so FFTR mid bound, upper bound and lower bounds average, we don't see that changing anytime soon because the inflation will still be high. India, we thought that we go from 6 down to 5.5, which we have, and then stay there for the rest of the year. So I think not great news for yield and interest rates. But other than that, I don't think India is losing out a lot vis-a-vis its competitors. And Russia Ukraine is not really something that impacts us in a big way.
Thank you, Jigar, for that. And before we move on to the next question, just if in case anybody has any questions, you can drop it in the Q&A section and we can take it up towards the end of the session. Moving on to the next question, Jigar, at the start of the session, you also put some light on, the US dollar and how is it losing strength. And, these uncertainties raise questions about the resilience of world's largest economy. So if de-dollarization picks up pace globally, especially with countries moving away from the US dollar, how will it be a positive for India? What all factors and what kind of impact should we expect?
So that Aakanksha is ongoing, right? If you look at, say, in the late 90s, so 1999 was when the euro was introduced. Dollar was at around 81 or 79, I may be missing 81%, let's say, of the global reserves. Today, that number has fallen to 58%. But US still is, if on 80% of your global transactions, 60% of SWIFT transactions, and a third of all $100 bills circulate outside the US dollar, outside the US country. So clearly, it's a behemoth which you can't tackle in a decade, right? You have to these transitions take place over 2 or 3 decades, and therefore it's not something that we think happens overnight. It's a slow
It
burn.
has expedited, right? The process has expedited.
Yes, so it's a slow burn. It incrementally it might take place, as you said, at the margin. The things that benefit out of this, obviously, India's majority sort of reserves are in the US dollar. So clearly, that's not something that we'll be very happy about. But incrementally, if you want to de-dollarize, each country will do it in their own way. Let's say if you are India, obviously we are among the largest holders of gold as a sovereign and within households, by a far measure. If you are China, you will do it through commodities. If you are, say, in the US, you would want to do it through Bitcoin. So anything denominated in a fiat currency loses its value, and anything with limited supply, which may include land and real estate, which is why you have seen, despite its unaffordability, you are seeing a lot of people put their money, plow their money back, and therefore those are the commodities and gold which makes India a lot more resilient compared to its peers. Net, as I said, there are some losses because of the 650 odd billion dollars of assets that we have. A large part of it is in the US dollar. So not great news for that, but incrementally we are better off with not a single currency as a peg.
All right. And also, Jigar, so since we are talking about global factors, so last to last year, ever since last to last year, we have been very vocal about China plus one. And we have talked about how China plus one will indirectly be a positive impact for India. However, just to talk about other countries which benefited from China plus one, in fact, had benefited higher, like Vietnam, which is 7% of India's population, had quite surged ahead by its manufacturing growth and many other parameters. So I know that Vietnam does not stand as an economic challenge as compared to India, but still, what do you think we can learn from a country like Vietnam, which has gained ground in exports and investments? What's working for them?
Two things work. I don't know if we would want to replicate that. One is the MFN status with Europe, the most favored nation status with Europe. Now, if you look at, so where is Vietnam and Bangladesh really? What they are really exporting is textiles, right? Their MFN status with Europe gives them a 6 to 8% duty advantage compared to India. Now, when you look at most of these textile players, their margins are 4, 5, 6%, right? And therefore, when you have a 8% duty differential, it's becoming extremely, difficult for Indian textile companies to compete. Where sort of these players are not MFN, like for example, US, Indian textile players are very large, like one in 5 Bed Bath and Beyond towels is an Indian company, Wellspun Textiles, right? So very clearly there, India really rules the roost. But for countries where they are giving a large duty differential, these countries benefit. Secondly, is with respect to how the federal structure operates. And with smaller economies, you can do this, but a country as vast and diverse as India, the federal structure brings a lot of advantage, right? The Indian civilization has flourished and survived since long before the Mesopotamia. So net, it is this sort of DNA which was inputted in us, which allows us to, survive for longer, but it brings the intermittent challenges along its way. And therefore, my sense is that that's a cost will continue to play. You can reduce, or arguably, you can argue that sort of federal rate tapes reduces, but as I said, it's easier said than done. The third part, which I think we can truly learn from them, is the lower labor costs, because as I stated at the start of this, you essentially had a situation where a country grows by having its labor costs lower, and if India is not able to do that, then becoming the manufacturing hub will pose its challenges. Now, if you looked at the state budgets, uh, and for the lack of a better word, I'm calling them freebies. The freebie bill, the announced freebie bill is coming close to the capex spends. And therefore, if Narega and Manrega were sort of not great for manufacturing, the way in which a lot of these states are going is in the same direction. So net, you would end up having sort of very questionable path to India's manufacturing prowess acquisition, which may not allow us to do that. So if I could change one aspect, is make a lot of the state budgets a lot more responsible. Same goes for the central budget as well, and therefore sort of get people to earn their keep rather than give it as a freebie. In which case, as a country, we would prosper a lot.
In fact, my next question was on the same grounds. What role is government capex really playing in driving growth, and can it continue at this pace?
So if I add central, state government and PSUs, they were driving about 30% growth in the past 4 years or so. Historically, so if you take the gross fixed capital formation in India, in fact, why don't I sort of bring that slide up altogether? So when you look at the gross fixed capital formation in India, that is driven. I may have pushed it at the back. Give me a minute to find where that is. Sorry, I may.
No problem. Please take your time.
Yeah. Right. So I think I may have removed that. Apologies. I'll try and break it down. The total gross fixed capital formation, if memory serves, is around 80 lakh crores, which is split equally, right? 20 lakh crores is center plus state, 20 lakh crores is private corporations, and the balance 40 lakh crores is infrastructure. Now, this 20 lakh crores, the state and central spends, which was increasing dramatically, was pulling India's growth higher. Uh, the corporation spending, we see it in two distinct eras. Prior to 2015, the banks were rather lenient with lending. Promoters in India didn't go to jail. The IBC, the bankruptcy code, wasn't established. So a lot of unscrupulous promoters kept doing the capex, and that may not be in the national interest. But as far as it relates to capex numbers, it was all showing hunky dory. After 2015, with the changes, the capex intensity to GDP has fallen, albeit it's rising. So private capex, if you look at last data, it's rising. Capex to cash flow from operations is rising in the most recent numbers. But net, it's not keeping its intensity with GDP growth. Now, I mentioned about the state capex, which is slowing. The freebie bill has essentially pushed capex for states into the negative number, which was growing at 40%. And central government prioritized fiscal prudence over capex, over capex spending in this year. So net, I think what government has realized that a lot of people want money into their own hands. With the income tax spends that happens, the savings 1 lakh crore. Central government have announced 3 lakh crore, but I think 1 to 1.5 lakh crore is what they would end up delivering. So 2.5 lakh crore goes into sort of the hands of people rather than capex. Capex has a higher money velocity, so the N3 multiplier of capex is much higher than consumption, and therefore it's not net a great positive for the country. But it would result in higher money, and therefore some sections of consumption discretionary will do a lot better.
Thank you, Jigar, for that. And so my next question is again on the multiple sectors and market trends that we have talked about. What, as per you, as we go forward, what trends do you think will shape the investing over the next decade? ESG, crypto, fintech, what as per you?
So one sort of the mega theme is that India is not Japan of late 80s, right? That's a very critical distinction, because the Nikkei of the late 80s, 89, the levels we in between breached, but we are even today at the same level, net. So 35 years of lost index. Now, if we argued that labor force participation and productivity gains will happen, which brings the India's fundamental fabric reasonably resilient and flows will catch up, then India's market is reasonably on its trend up. So I think the mega trend is essentially India as an asset class does make a lot of sense. What we might want to ensure against is this over exuberance time and again. See, over the longer term, your 5 and 10 year rolling return, the markets have been at 12% index returns, small cap or large cap. Right? A lot of people think you make a ton of money in the small cap. That's not really the case. Now, at 6 odd percent rolling return alpha, Buoyant as a fund is sort of a top quartile on 1, 2, 3, 5, and 7 years. So if you add that to say 12% index return, 17, 18% is what the top quartile funds are delivering. 40% returns happen once in a while. In September 24, everybody assumed that 40% is the norm and, we have to just buy businesses that do that. And a lot of those stocks corrected more than 50% in the next few months. So if sort of we start believing that essentially the cycles are gaining a lot more prominence, but the mega trend is an upward trajectory, then if we can ensure against our biases, we keep our good head on our shoulders, then I think things are reasonably okay. In terms of sector specific themes, I think consumption as a theme, especially discretionary, is something that we think will make a sizable comeback. A lot of money has moved in the hands of people. RBI, central government, state governments has pushed money, and I think it will show up in consumptions in different ways. We don't expect that to be a staple-led consumption growth, but a lot more discretionary-led, and there are a number of ways in which you can play this. ESG as a theme, I think, was overextended. I don't think that continues because it fundamentally doesn't make a lot of economic sense. Besides that, I think these are sort of the things we are broadly believing.
All right, thank you. So in fact, Jigar, you talked about Buoyant PMS and how it has been performing. In fact, as we talk, it has been in the top quartile and the top performer in the multi-cap space. So and what I've seen is since 2016, this PMS industry has picked up, and in fact, it has been in a lot of limelight lately. So, what as per you is driving growth in this PMS space right now? Is it pure performance, or is it personalization, or simple market momentum?
Two or three things, Aakanksha. First is that, nothing against mutual funds per se, but you have a straitjacket approach that works for everybody that creates some bit of problem. Secondly, size in and of itself is your enemy in asset management, especially in a illiquid market like India. So let's say if you're running a 50,000 crore fund and you want to buy, say, 7-8% of your fund into a company, you are looking at buying what? 4,000 crore worth of position. Let's say you don't want to be more than 10%. So anything below 40,000 crores is really a no starter for you. Secondly, because the mutual fund investment team and the people investing therein are so dislocated, mutual funds don't think they can underperform even for 6 months if they think markets are crazy, right? They have to align themselves to benchmark. Because 25% of your investors are moving away every year, and therefore they hug the benchmark, and that creates a questionable situation, right? In our case, we essentially run it the way we think fit. If we don't like IT, we have zero exposure. If we love a company, we have like 6, 7%, 8%, 10% exposure. So running it in a way where you can let your convictions run and communicating it effectively aligns yours and the end investor's interest. That you can keep communicating, like say, for example, we did, saying between say March and September, we were not in sync with the market. Right? We thought the market is running on fumes and excesses. So we communicated to everybody that we are not even trying to outperform. Right? We are not looking at business, we're just trying to protect the capital. And that's when we managed to protect the capital. When at the peak of the market fall in February, the small cap index was down 25%, broadly speaking. BSE was down 20%, we were down 14%. And today, from September levels, the indices are still 6-7% down, but we are up 3.5% from September level. So because we could communicate this in a lot more efficient fashion, through our webinars, through our memos, through our investor communication, the investors' understanding in how we play cycles increases. And having seen 3-4 cycles, they realize that, look, we are not getting swayed in either direction. So I think communication allows the ability to run the fund the way you think fit. And as long as it is not creating a size barrier, as an asset class, this provides great opportunity, I would say.
Jigar, any upcoming regulatory changes that investors should prepare for in the future?
In the PMS space?
In the PMS or in general?
So I would say incrementally, SEBI, rightly so, is working a lot in making sure that the communication is seamless. So you start from the way in which results were reported, right? We were so surprised to see people reporting best investors returns and first investors returns, and then SEBI said nothing doing. You have to regularize this, right? Standardize this. Everybody does the same thing, and now people don't even sort of think out loud, right? Whether these returns were actually delivered or not.
Yeah.
Eventually, it helped the end investors by making sure the alternative funds report in the same language. Then, increasingly, I think they're doing a lot more to make sure that there is an equitable allocation. People are not fly-by-night operators. They put their own skin in the game. So I think net-net, we are increasingly going towards mutual fund sort of regulations. But we see them as all steps in the right direction, because it allows people who are really interested in running this business for a long period of time connect with the end investors such that it becomes a win-win solution. Right? If PMS managers win at the cost of end investors, that's not great. If the other way around happens, that's not great either. A value is created that gets shared. I think that works out to be the best. So at least I am not privy to something that is in the works yet, but SEBI has done a lot, including sort of systems audit, visits, auditing all the, or not auditing, but at least physically verifying the PMS managers by almost 90% by value. So all those are sort of steps in the absolute right direction.
All right. Now let's have a look at the Q&A section. Please put in your questions, if any. I'll read the questions that we already have. So one of the questions is, what's your sense on India's valuation premium versus other emerging markets? Is it justified?
Valuation, Arihant is asking this is, as we say, in the eyes of beholder, right? There's no, although you can argue that PE, PB and justified levels exist, but net, it is essentially what people are happy to pay. And I think given the flows, you can't justify it on paper. India's ROE is at a slight premium. But as I said, domestic savings have very limited way of getting invested. Earlier, it was real estate. Now that real estate increasingly is not all that attractive, markets will become. And real estate stayed overvalued for a fairly long period. I don't think anything else would result in very different numbers for Indian equities. So on paper, difficult to say that this is the right number. But I think given the flows, adjusting for it makes sense. Sometimes we jokingly argue that, we used to talk about PE numbers, that 15 is cheap, 30 is expensive. We should rebase everything to now, like 30 is the base number. If it's a 45p, you only talk of it as 15p, and then that way it will start looking cheaper. So on a lighter note, I think if we rebase everything to 30, India is extremely cheap.
Thank you. Jigar, moving on to the next question by Amitosh. Can India's booming consumption and infrastructure push meaningfully lift corporate bottom lines? Or will margin pressures and global volatility dilute the impact? And the second part of the question is, and how is the public-private involvement ratio in this domain now, and what ratio is needed to succeed?
Meaningfully lift corporate bottom lines, Amitosh, yes. If you look at corporate profits to GDP, that number went down to 2.3% in 2014. That's ballooned to, I think, 6.5% is memory serves. But don't hold me to that number. I think that's gone up for sure multiple times. it's really up there. Government was trying to crowd in private sort of investments, and I'm taking second question in conjunction with this. That government was trying to crowd in a lot of private capex, but as I said, earlier the banks were writing a free optionality to a lot of these unscrupulous promoters, which is no longer happening today, and therefore that number is not at an optimal stage. But the risk takers are reducing by the hour. A lot of second generation promoters, and I keep speaking to a lot of family offices in India, and the second generation is not so much interested in manufacturing as much as they are in running a family office. By extension, more entrepreneurs are becoming investors, and that will not really help this ratio improve anytime soon. So net, I think a lot could be done, but given the economic challenges, we are reasonably up there in terms of where things are.
All right. In fact, moving on to the next question, commodity was one space which we did not touch upon. So Sonal has asked, between gold and silver, which one makes more sense to invest in right now? And there has been a regular buzz why silver seems more attractive. So please, Jigar, what's your view on that?
So silver has some industrial use. Gold is largely used for ornamentation and ostentation. Uh, but at the end, and a lot of people I know refer to this ratio and how long-term ratio work out. But our sense is that dollar debasement does well, as we discussed, for a lot of commodities, including gold and silver. Now, given that the rally we have seen with both these, I would be a little wary of putting a lot of money to work incrementally here. It's much more a capital. If your capital allocation has very limited allocation here, then you can think about increasing allocations. But net, buying it as an active investment call, I would wait for it to stabilize. The frenzy is simply too large right now for you to take incremental positions. Long term, bad dollar means good commodity prices. So should have a healthy allocation. But if you have zero allocation today, wait for it till you start building out one.
All right. Moving on to the next question, it seems a little interesting. Only if we could talk about stocks, Jigar. So the next question is that are there any specific industries which you think are still undervalued? I think this question was answered, but still, Jigar, if you have few sectors where, because you mentioned about banks and you mentioned about consumption, but if in case in particular you find few other sectors like energy or some other spaces, if you can throw some light there.
Right. So industries, Unnati, are, as we mentioned, we are interested in pharmaceuticals, sort of chemicals, specialty chemicals, cement, banking, to name a few. Stocks, obviously, we won't be able to discuss, but sectors, these are the places which make a lot more sense. Undervalued, or sort of, I won't go as far as to say they are undervalued. They're fairly valued, but I sense that the sort of growth which we likely see in many of these will outweigh the challenges that present themselves. So these are the four sectors I would keep a close eye on.
Moving on to the next question. Any tactical shifts that retail investors should incorporate in portfolio post tariff tantrums and RBI dovish pivot?
Generally, not as far as as far as it refers to tantrums or pivot, but see, increasingly, as I mentioned, when FIs used to drive the markets, there was a lot more, controlled view on what the businesses should be worth. And whenever markets overextended themselves, there was a self-correcting mechanism in place. So there was both a mechanism where things didn't overextend, and there was a mechanism where it didn't extend on the either direction. Now, with a lot of retail investors driving markets, we feel that there is a lot of information which is out there, but that is precluding them from creating, or investing time in generating sort of, real insight. So it's the war between information and insight. Lot more information, a lot less insight, which is creating this sort of the amplitude of the waves around the mean to go up dramatically higher and lower. Let's say if this is the mean, then earlier the markets used to be like fairly close, right? There's still opportunities, but the standard deviation around the mean was a lot lesser. Now with retail, the amplitude on the way up and way down is equally higher. And therefore, you must always have, in my opinion, some sort of understanding on what this business is worth. And eventually, when you achieve that price, learn to book some amount of money out rather than continually staying buy and hold as a framework. So no tactical shifts vis-a-vis these events, but these events will become catalyst to the cycles gaining a lot more prominence, which will force you to do a lot more tactical shifts.
So, Jigar, what would be your suggestion to somebody who has to build a portfolio in the current scenario? Will you be uh, will you be biased towards large caps because you see, I mean, given that you have to construct a portfolio in today's day and environment, what would be the right advice as a breakup between large, mid, and small?
We are sort of, see, we were almost 63% small cap post COVID, post Russia Ukraine. Recently, sort of by September, we were predominantly large cap heavy. And the correction that happened allowed us some opportunity to dial the small cap exposure higher. But again, from sort of March, the markets again have rallied a little bit. So we have paused that framework. We are, I think, now equally split large cap and mid and small cap, 50 to 48. I think if I memory serves, that is the broad allocation. I think we'll continue with that because if it's sort of flows that is driving the stock prices and not fundamentals, then eventually you'll get opportunities without an apparent trigger inside to dial the risk up again. Like Jan Feb, a lot of contemporaries of ours fell double digits. A lot of stocks corrected more than 50% in the drawdown. If we get the businesses we are interested in at attractive valuations, Aakanksha, then we'll be happy to dial risk up. But today it's as even Stevens as it gets.
Sometime last year, in fact, June last year, you had been very vocal about the valuations of the market, and that will be a reason why there we can see a correction, that we are expected a correction. And it happened so ever since October, we had seen the correction, and particularly we got multiple factors which became the reason for the correction in Jan, Feb, March also. Do you see something like this in the near term, or do you see the markets will probably smoothly have a move towards the upside from here?
No, I think corrections will be part and parcel. If the rally wasn't as severe post February correction as it has been,
Yeah.
uh, I wouldn't have gone so far to say that you could have had a soft landing. Typically, the stocks that led the last rally are not the ones that lead the next rally. But
Correct.
if you look at this, and 25% drop in any index is a reasonably good understanding of a fall, then the sectors that did well in the run up are again the ones that are doing well, which tells you that the euphoria is not completely out of the system. So you have to argue one of two things. If, let's say, for example, in defense, the sectors continue to do very well, then at certain point you would need to argue that the earnings grow up materially, right? And in absence of that, the valuations have to come down. That are the only two arguments you can make. We are not in a position to make a very strong argument that the listed space in defense will see, say, for example, a great growth. And therefore, we are not all that gung-ho on defense. Now, the same goes with the market, right? In March, we were talking, sorry, in September 24, we were talking 14% earnings growth, 26% sort of market returns. That slowed down now to 5 and 8%. But net, there is still this sort of 3%, which is incrementally building up for 3, 4 years, and that needs to be taken out. So I think whereas the investors' appetite has come down, not a lot of family offices I meet now talk about 30, 40% returns. But the same stocks are driving the next rally, which is a little bit concerning to us. So you will see more frequent sort of froth removal exercises without apparent triggers inside than we would have ideally.
All right. Given that we have limited time and we are running out of it, so with that, we will wrap up the session here. Thank you so much, Jigar, for a very interesting and insightful session. Always a pleasure listening to you.
Thank
And thank you to all the attendees as well. Street Experts will be back with more such interesting discussions. In case any questions remain unanswered, do reach out to us through your respective RMs and through our website www.mastertrust.co.in. With that, we would like to conclude this webcast. Thank you all for tuning in.
Thank you, Aakanksha. Thank you, everyone.
Thank you.